Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the 54th episode of the Retirement GPS podcast. I'm your host, Ryan Zacharczyk, Certified Financial Planner and President of Zynergy Retirement Planning. And today we're going to talk about perhaps one of the most important topics in regards to your retirement, and that's safe distribution rate. So how much can you live off of in retirement? Now, we've talked about this topic in the past, and we've talked about the different rules of thumb and the way people think about distribution rates, because let's face it, everybody wants a magic number when it comes to how much money they have and how much money they can live off of. And people ask us all the time, can I spend 10% of my portfolio? Can I spend 5% of my portfolio? What's the right number for me? And unfortunately, retirement doesn't work that simply. Today we'll discuss what really determines how much income your portfolio can produce and how much can you live off of so that you accomplish multiple things. Number one, that you don't run out of money in your retirement. Isn't that our most important goal? We don't want to run out of money. The last thing you want to have happen is you spend your last dime when you're 88 years old. But guess what? You're not dead yet. You're still alive. It's very tough to go back to work at 88 years old because you have no money left. Second, we want to make sure that our income keeps up with inflation. So it's one thing to say, I want $3,000 a month of income, which is great and may be very comfortable for you today. But 10 years from now, 20 years from now, will that be comfortable? And the answer is almost certainly not. Inflation will eat away at that purchasing power year after year. And third, we want to make sure that we're not dealing with too much volatility along the way. Having the right asset allocation in place so that we can maintain our distributions is going to be a really important priority here. So we want to make sure our money doesn't run out. We want it to increase with inflation, and we want it to support us through the rest of our lives through good and bad market environments. So what is a safe distribution rate, and exactly what are we talking about here? What we're talking about is the percentage of your portfolio, your assets that you've accumulated, your nest egg, your retirement portfolio that you can withdraw each and every year. And typically when we talk about distribution, we talk about it in terms of months, but the rate is going to be a percentage, an annual percentage. So the goal is to produce the income without running out of money. We want to be able to draw from that rate. Now, the standard rule of thumb, and what you've probably heard quite a bit about, is the 4% rule, which comes from Bill Bengen, who did a study in the early 90s. And he back tested all sorts of data going back for 30-year market returns, going back for 150 years. And he was very thorough in his testing to see in good markets and bad markets how much can a retiree, even if they retired at the worst time, because we don't want to assume that you're going to retire into good market environments and good times. In fact, we want to assume the opposite. We want to retire conservatively and say, what if I happen to be retiring at a bad time? I'm just not lucky. So what Mr. Bengen did was he went back and he stress tested, and he said, what if you happen to retire in 1929? What if you happen to retire right before the tech bubble burst into the financial crisis? And he did this actually in 1992, so he didn't stress test. He has since updated his research every single year and just came out with a new book on all his newest research, but he stress tested all those periods. And actually, the time that he found, which was the worst time to retire, was actually not 1929, when the market crashed, biggest market crash in history during the Great Depression. It was actually the worst time to retire was 1968, because one of the assumptions that Bill Bengen made was that your income needs to go up every single year with the cost of living. So whatever the number for inflation, we call it CPI, right? So Consumer Price Index, whatever that number is for that year, in Bengen's research, you're going to increase your income by that much. So if inflation was 1%, then next year, whatever you were drawing from, you'll increase by 1%. If inflation was 12%, next year you'll increase your income by 12% to keep up with inflation, right? And it seems logical, right? Because if we have property taxes that are in New Jersey, it's not uncommon to have property taxes to be $14,000, $15,000, $20,000, and they go up 10% next year. It's an extra $2,000 you need in 1 year. You start compounding 2, 3, 4% inflation rates over a long period of time, and your property taxes are going to double, triple, even quadruple in your lifetime. We need to make sure our income is going up with that. So tying it to CPI is a great strategy to accomplish that goal. So by back testing his data, he used a very, very simple portfolio of 60% stocks and 40% bonds. His stock portion was the S&P 500, nothing more, and his bond portion was the 10-year Treasury, nothing more. And he ran that forward using 30-year periods. So he assumed a 30-year retirement. Now, you might say my retirement's going to be less or going to be more. I think we probably need to plan that our retirement is likely to be more. People are A, retiring earlier, and B, they're living longer, right? So the average assumed age of death is no longer what it was, especially in the early 90s. You want to assume that you're going to live into your 90s because, like I said, you don't want to be 88, 89 years old, run out of money because you're retired at 58 or 59 for a 30-year retirement, and then say, yeah, but that's okay. I don't need money anymore. I'm 90. The truth is, where are you going to get your money from? You'll be living off Social Security. He came up with the 4% rule, and essentially what that 4% rule, and by the way, his 4% rule was actually 4.15%. And I actually saw him speak very recently at a conference I was at. And he said when he came up with the 4.15, he's a statistician, he's a numbers guy, so he was very specific about the 4.15, and the industry just rounded off because it's very hard to communicate to clients that 4.15 is the right number. Now, what that means is we're going to use 4% again because I'm part of the industry and because we like to round, and it's an easy number to understand. But if you had a $2 million portfolio, the 4% rule says that you can draw $80,000 a year to live and draw that for the rest of your life without running out of any money during any period, even if you retire at the worst time. Now, the worst time to retire is actually 1968. It wasn't 1929. It wasn't the Great Depression. And the reason was because in the 1970s, the market had a pretty significant correction. Not as big as the 30s, but it was a pretty significant correction. But it was also tied to very high inflation. So you had this period which was a huge stressor on the portfolio. So values falling in the portfolio, stock prices falling, but prices in the real world were increasing. So it costs more for eggs and for milk and for gas and for postage stamp and property taxes. When you couple those two together, it put a lot of stress on the portfolio. However, if you drew 4.15 with Bill Bengen's 60-40 portfolio, you lasted 30 years and did not run out of money for 30 years. So that was the crux of his research. That was he's trying to accomplish. The good news is a lot has changed in the last, say, 30 plus years since the early 90s. And financial planning has gotten a little more sophisticated. Number one, we don't use a very simple portfolio of 60% S&P 500 and 40% 10-year Treasury. We're able to build more diversification into our portfolios. A lot of people get frustrated with diversification because if I have international stocks or I have investment real estate or REITs in my portfolio and those underperform the S&P 500, I get really frustrated. Why am I not in the S&P 500? But the truth is, if you look over long periods of time, that diversification is actually going to perform better and allow the portfolio to be less volatile, which allows it to last longer. And if you go back and stress test, so Bill Bengen's new book, which came out last year, it's called A Richer Retirement, Supercharging the 4% Rule. He actually stress tested using a more diversified portfolio. So he has small cap stocks in there. He has international stocks in there. He has REITs in there. He has different types of bonds. So it's not just a 10-year Treasury. He also has inflation protected bonds and short-term Treasuries and cash. And by having that more broadly diversified portfolio, some things are a little more aggressive and some things are a little more conservative, but it's more diversified. He's able to take that 4.15% rule and take it up to 4.7, which now we're pushing 5%, which is fantastic because if you retired in 1968 with a more broadly diversified portfolio, you actually could have drawn 4.7% and had a comfortable retirement. That research was really what I found very compelling because it puts a new spin on the 4% rule. It really is now almost a 5% rule. And the other thing we have to remember is that was 1 year. That was actually the worst time to retire was 1968. And in 1968, if you did retire, most people actually collected pensions. So most people actually didn't even experience this problem. We're just really trying to back test if a retiree today would experience that type of market, high inflation and a falling stock market. In fact, if you were to retire in 1929 at a horrible time, you actually could draw more. You could actually draw about 5.5% from your diversified portfolio because inflation was so low. There was actually deflation during that period, so it didn't put as much of a strain on your portfolio, even though it was falling. So we look at all of this information, and what's really interesting is if you happen to retire at a good time, if you happen to retire in 1981, 1982, the distribution rate you could have taken over a 30-year period is in like the 9 and 10% range, which is absolutely incredible. But of course, we don't want to assume we're the luckiest person in the world and retiring at the best time, right? We want to assume going into retirement, we're the unluckiest person in the world and happen to be retiring at a terrible time and watch our portfolio grow. And then we can increase spending perhaps in the future if things are going a lot better than we think. But this all kind of comes back to the question of what actually is my safe distribution rate? What can I draw from my portfolio? And we tend to have a general rule of thumb that we say in the 4 to 6% range is where we like to see people draw. But there are a lot of variables that play into that calculation. We want to talk through some of those variables. When you're thinking about your own distribution rates, your own safe distribution rates, what do you want to draw and how much do you feel comfortable drawing to make sure that you're maximizing your retirement income? Two things to consider. Number one, when we draw, we are going to count every single thing that comes from our portfolio as a draw. Okay, so that could be your income, but it could also be the taxes on that money that you have to draw, such as from a pre-tax IRA. So if I'm drawing from a 401k or an IRA that's pre-tax, and my 4% rule says I can draw $80,000 a year, but I have to pay 25% of that in taxes, I'm only living off of $60,000. I cannot draw $100,000 or $105,000 and say the 4% rule says I'm going to live off $80,000. Just remember that is everything out of your portfolio. The other thing is fees. Fees will count against your distribution rate. So that 1% you're paying an advisor potentially will count against the distribution rate. If you're doing it yourself, that's fine. But understand that you may not be able to adapt to market problems as quickly as if you had an advisor advising you. So that's the first thing to consider is 100% of everything that comes from the portfolio in any given year counts as your distribution rate. Second thing to consider is we are talking about a 30-year retirement. So there are other variables that play into this. If you're retiring at 58, you may have to, and in fact, if I were your planner, I would tell you we are considering a longer than 30-year retirement. We're probably looking at a 35-plus year retirement, depending on what we set mortality to. And in financial planning, I typically like to see people set mortality from 90 to 100, depending on a few factors there. We may need to be a little bit more conservative when it comes to that. So let's talk about some other variables that come into play. Number one, and this is right in Bill Bengen's book that recently came out, is he basically assumed that you retired in any type of environment and stress tested every environment. You can actually try to make predictions of the environment. It's not like trying to forecast the future, but it is taking a look at where are both market valuations and where are inflation levels when you retire. Now, of course, we don't know the future. We don't know what inflation levels will be in 5 years or market valuations will be in 5 years, but valuations today are a pretty good predictor of performance over the next 10 to 20 years of time. What does that mean? The PE ratio historically of the S&P 500 is between 18 and 20. If we're running a 24 or 25 PE ratio, that means values in the S&P 500 are very high. The PE ratio that Bill Bengen uses is the Case-Shiller PE ratio, which is a moving PE ratio. It's called the CAPE. CAPE. You can look it up. You can look up the CAPE of any market environment. So where are we today? What's the CAPE for today? Is it high? Is it low? The higher the CAPE, the lower the distribution you should consider. It means market valuations are high historically. Prices are high compared to the earnings. It doesn't mean the market's going to crash. It doesn't mean it's going to be terrible, but it does mean performance over the coming years may be less than historical. Typically, performance following high market valuations is poor, and performance following low valuations is good. As a simple example, if you bought stocks, even if you bought stocks in 1997, right? You had 2 more years where the market was up like 100% during the internet bubble, but the burst lasted 10 years, and it was a terrible performance for 10 years. So if you look at that performance in aggregate, that 12-year performance, it was not good. An average annual return from 1997 to 2010 was terrible. The opposite's also true. If you bought stocks in 2007, 8, 9, when valuations were very low, let's just say 2008, 2009, when the market bottomed out, you may have thought, I'm not going to get a good return on my stocks. Stocks haven't done well in 10 years. But the Cape-Shiller index showed very low valuations, which means you're buying things cheap. And if you're buying things cheap, you tend to do better in the future. The next 16 years, and here we are 16 years later from 2010, from 2007, we're 19 years later, performance has been phenomenal. The S&P 500 has well outperformed its historical performance. So if I were retiring in 07 and 08 and 09, I could be a little bit more aggressive with my rate of return, my distribution rates. And that's what we see, and that's what we even recommended for some of our people that we were doing planning for in 07, 08, 09 into the recession is, listen, valuations are already very low. You can distribute 5% comfortably and not have to worry about it, and that's exactly what people were distributing. So these things are really important to look at when you're thinking about where we are. The second thing to look at is inflation. We're not going to nitpick over is inflation 3.5% or 4% or 3%. But basically, if inflation's below 4%, then that's a favorable inflationary environment, which means you can expect that things are going to be pretty good going forward. We have no guarantee that inflation's not going to spike up in the future, and that could absolutely affect your distribution rates. But as we stand right now, we're running at, let's just say, roughly a 3% inflation rate. So we're in a pretty favorable inflation rate, even though we are at a high market valuation rate. Let's talk a little bit about spending flexibility. It's a huge concept because if you want to take a little bit more of a distribution and understand that if the market corrects, I may have to pull back my spending. I might have to reduce my spending. And we need to make sure that we're breaking out our discretionary spending versus our required expenses. So things like your mortgage, your property taxes, your food, your insurance, these are non-negotiable. We have to pay these bills. If we're not going to pay our electric bill, they're going to shut our lights off. So these are non-negotiable expenses. If inflation is 10% and our electric bill goes up 10%, we have to pay it, even if the market's crashing. However, there are discretionary expenses such as a new car, such as travel, home projects that we can defer or delay if the market corrects. And if we build those into our budget and say, yes, we want to live off of $80,000 a year, but if things go really bad, we're going to take a break from travel. Maybe we won't do the home projects during those bad times. We're just going to cut our spending. And you have discretionary in there to do so. That will actually allow you to draw more from your portfolio, even up to 6%, and wait, see how things go. See how the first few years of your retirement go. The early years of your retirement are far more important than the later years of your retirement as far as performance. If you have a really bad couple of years in your investments, the first 2, 3 years, 4 years of your retirement, it's going to impact you a lot more than if those bad years come much later in your retirement, simply because of the compounding. The other aspect of this that you want to think about is your guaranteed income sources, right? So if we have Social Security, if we have pensions, if we have rental income, annuities, other guaranteed income sources that are going to pay those required expenses, and the distribution from our portfolio is mostly discretionary, we can be more aggressive with it. Because again, why not? We can cut that discretionary if we want to. So when we talk to people about their distribution rates, we really try to get a handle, not only when we're doing retirement planning, we're looking at the entire picture. So we're looking at those guaranteed income sources, but we're looking at how much of their spending is planned to be discretionary versus required, and we'll adjust the distribution rates accordingly. We talked about taxes, so make sure that taxes aren't overlooked. You'll have to pay your taxes if your money's coming from pre-tax IRAs, 401ks, which most retirement income distributions are, especially once you hit RMDs. A lot of the people that we work with, if they haven't set up proper tax diversification early, which we constantly are pushing the people that we get years before retirement, is let's do Roth conversions. Let's save money in Roth IRAs or taxable brokerage accounts to complement the 401k we've been building over years and years. So we want to make sure that we look at the income diversification they have before we make a distribution. We want to look at the income diversification they have before we make a recommendation on distribution. So why one number doesn't work? Simply using an example, if there's two different couples, couple A retires later, meaning they looks like they're going to have less years of retirement because they're retiring at 67, and we're saying, okay, probably looking more like 25 years of retirement. They have a higher pension, they have a higher Social Security because they delayed it all along, and their spending's pretty flexible. Guess what? They can probably comfortably consider a 6% distribution rate, even if they have financial advisor fees, as long as we watch it and we keep an eye on it. If they're going to do it by themselves, I would recommend probably a 5% distribution rate, so they really just don't ever have to worry about it, maybe even 5.5%. But those are the variables that would improve their distribution rates. If somebody retires at 58 and they have no pension, they've got several years before they're going to collect Social Security, and they're drawing all of their income purely from their investments, we're going to be more conservative, without question. We're going to say probably looking at 4.5%, because when you back out fees and taxes, that's going to be about the right number for you longer term. So even though the portfolio is exactly the same, they have different variables. So what we do at Zenergy is we don't start with your retirement distribution rate. We start with, what life do you want to live? What are the variables that are going into this retirement? And then we build around those variables, things like your cash flows, your taxes, Social Security income, investment portfolio. If you have a really low risk tolerance, we might have to reduce your distribution rates. Really high risk tolerance, meaning that you're way too aggressive, we also may have to reduce your distribution rate. So those things are important. So the takeaways here are, just understand there's no one universal distribution rate. Work from a number of 4 to 6%. If you really want to be ultra conservative, if you're doing things yourself and you go 4.5%, you almost certainly can't go wrong. I can't predict the future. We're only using 150 years of data to analyze this. So please understand that there is a risk that something happens, something occurs that has not occurred in the last 150 years, and it derails your retirement. So predicting the future is an impossible thing, but using 150 years of data, it shows that 4.5%, doing it yourself would be very comfortable. But just make sure you're looking at all of the variables. Are you retiring at a high market valuation? Is there high inflation when you retire? Retirement success isn't about maximizing your withdrawals, it's about making your money last longer than you do. So if you're wondering how much you can safely spend in retirement, give us a call. We'll be glad to sit down with you, talk it through, and see how we can help you. And thanks so much for joining us on our podcast today. If you want to learn more about these great tools that we use with our members every single day, please make sure that you follow our podcast. Make sure that you subscribe. You'll get brand new content every Tuesday morning in your podcast inbox. You'll be able to listen to this new content. We try to keep it short and we try to keep it actionable so that you can wake up tomorrow and actually use this information. Follow us on Facebook, Instagram, LinkedIn. Make sure that you've got us liked so that you're getting this content as well. We put it in blog form, so if you don't want to listen to it, you can read about it and read some details. And otherwise, keep learning, keep planning. See you next week.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog Mile Markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.